welcome back. You're still watching Informed Investor. Topic of discussion as we kick off this new series is insurance as an asset class in itself. So Puneet, let's pick up that issue of ULIPs. Enough has been debated about the pros and cons of it, but just walk us through what the new changed ULIP looks like. What's the 1, 2, 3 you can expect from a ULIP in its new form and fashion?
The new version of ULIPs is something that actually makes the proposition far more attractive for the consumer. I must clarify one thing that was mentioned earlier on the transparency part. In fact, the reason why ULIPs became very popular was because of the transparency they provided and because of the flexibility that is available in the hands of the consumer. So the consumer can choose the asset class, consumer can see where the money is invested, consumer can see where it is being, how the performance is on the basis of NAV, so on and so forth. So that remains as is in ULIPs. What has changed is basically 3 or 4 things. One is that the charge structure of ULIPs has been brought down substantially compared to what it was earlier. So that is obviously good news for the consumer. The second is that the minimum term has actually been increased. Earlier there used to be a minimum lock-in of 3 years. Now it has been made 5 years, so which makes it a relatively longer term product. The third is that the protection levels that are required have actually been mandated at a higher level.
Gautam, in this particular product, we are talking about a minimum guarantee that is being put forth. In that sense, would you say a ULIP is a more lucrative product in the insurance space?
After the capital markets regulator Bhave raised the ante that ULIPs were being missold to investors and that it needed to be regulated by SEBI, and then there was an ordinance that came out which took the regulation and put it entirely in the hands of ADA. The product has become better, I must admit that, and compared to what it was, ULIP is now a much better product. But even despite that change and lower costs, it is nowhere near a mutual fund in terms of flexibility. Let me explain that. Mr. Puneet says that you can choose asset classes, etc. and so on, but suppose the fund manager fails to perform in a ULIP, I have no option of moving to another product. In a mutual fund, if my fund manager fails to perform, I can exit and move into another fund. What I dislike about ULIPs, though it has become much better, is the fact that they are not as transparent as mutual funds, they are not as flexible, I cannot exit when I want to, and I don't know the cost structure. I mean, how much am I paying? You need to be a lawyer to read that policy.
Puneet, you want to respond to that? I understand, of course, that ULIP charges have come down substantially, but just on this point of performance parameters, where there is perhaps no one is really answerable for the performance of a particular product, how would you defend yours?
No, you will be surprised. There is a lot of pressure on performance. While I completely agree with Gautam that these are different products and need to be looked at in different light, the fact is that the regulator has mandated publishing daily NAVs. The portfolio is available. It is mandated again at a monthly frequency. So all that is available. I agree that the flexibility of moving out of the product is not available, but I think that by design is perhaps the strength of a ULIP product, because you force consumers to stay for the long run, and that's how they get the benefit. In terms of the other part about the charges and transparency, the fact is that in fact today ULIP is the only financial product in the country, and I must repeat that, only financial product in the country where there is something called a benefit illustration which is given, and it is not at the discretion of an insurer. Again, it is mandated by the regulator. Now it is possible that on the field perhaps some consumers are not aware of that, but the fact is it is mandatory, and here I would put a little bit of onus on the consumer also. All these tools are available. I think the consumer also needs to spend a little bit of time understanding this and taking the right call.
Just speaking of traditional products, though, Mr. Mathur, there is an issue which is more close to LIC than others, which is of bonuses, which makes this a more interactive product. Just walk us through the concept of bonuses for LIC in its traditional product portfolio.
Yeah, LIC has been declaring bonuses. I remember when early days of when LIC was set up, it used to be very low because interest rates were low. Then it improved, but again from 98 onwards bonuses have started coming down, generally because the interest rates have fallen compared to pre-98 levels. But yes, it is stabilized now, and bonus is an attractive thing because as per current tax dispensation, it comes without any involving any tax payment from the investor. So they are welcome. Only thing is, sometimes they do not keep pace with the inflation or the way inflation has been affecting savings.
Let me get you in on this, Gautam, because this is not traditionally part of the debate about whether it's an asset class or an investment tool or not, which is that ever since the changes on the ULIPs, we have actually seen people flocking more towards traditional products, as also being pushed harder in the market. What do you do as an investor when you understand the benefits of a ULIP, but the one that's been pushed towards you is the traditional? Is distributorship not a big issue right now?
It is, but can I just take Puneet on one more issue, if you don't mind? He said that there is a daily NAV. Now, that means that if I invest 100 rupees today and it rises by 10%, I should get 110 rupees tomorrow. That is not the case. When you look at those complex web of costs, you don't get point-to-point NAV. You get that in a mutual fund, where it is clean. My 100 rupees, if it rises by 10%, I get 110 rupees. The second part, as far as the long-term nature of an insurance product goes, I agree with Puneet. However, a cheaper and a more flexible product is the NPS, New Pension System. You are again locked in out there, and that is a much cheaper product than an insurance. Coming to the traditional plan, so it is not that consumers are moving towards traditional plans. What has happened is that after Bhave brought in changes, got the regulator in IRDA to change the ULIP product, the distributors, the commission structure for distributors is now suddenly in favor of the traditional plans. Hence, they are selling traditional plans. An investor doesn't know very much difference between a ULIP, and ULIP was just a nice exotic 4-letter word. Everybody was buying it, so you go and buy it. Now they are selling traditional plans. I think the insurance industry needs to introspect and look at what its incentive structure, what kind of incentive structure it is designing that is encouraging this sort of moving from traditional to ULIPs, when the ULIPs got more profitable, and now back to traditional plans because the commissions on ULIPs have fallen and they have not happened in traditional plans. So if it took Bhave to change the commission structure in ULIPs, it might take UK Sinha to change the commission structure on traditional plans. Before that happens, I would suggest that the industry as well as the regulator need to look at this and change.
Let's take a break on that contentious note. When we come back, more on the life insurance industry and of course more on this vehicle and whether or not it's time to start including it in your portfolio.